Target is down almost 30% this year, and there's investors now who are saying that now's the time to start picking up this beaten up stock, as the bad times won't last forever. That's what we're going to dive into in this video, but guys, first, let me run the intro. What's up, guys? And you can see here that Target is actually down approximately 30% year to date. And notice that in the midpoint of this year, the company did tell its investors that it expects its profits to decline due to decision to discount existing inventory in order to get it out of stores. And as of their last quarterly results, they do believe that that was the right decision to be made. And they actually expect better results going forward to the back half of this year. And that actually prompted Barron's News article by Teresa Rivas, where she said that it might actually be a good time now to be buying Target's stock. And effectively what she's saying is she's quoting Bill Smead, who's a longtime Target owner and chief investment officer of Smead Capital. And he says that it's a wonderful company with as sticky of a consumer base as there is. He sees it in the sweet spot for the millions of millennials who are forming new households and families. So essentially what he's saying is that as we millennials are forming new households, our wives are going to continuously drag us to Target, and that's good business. And he thinks that it makes sense to buy Targets on any dips that send it from the recent $165 per share back into the range of around that $140 to $150 per share area. So effectively what he's saying is that buy the dip anything substantially under $165 per share. Effectively, his reasoning is that everyone would like to wait for a better price, but those don't always present themselves. And here's where I actually think retail investors have the edge. I've been sitting on a pile of cash since mid-2021, and I have absolutely no one to answer to. I am happy to wait for the right opportunities to come, and they have been. All of the capital that I've been deploying thus far in 2022 has generated a return of approximately 16 or 17% with the market decline. And so when you compare that to the S&P 500 this year, which has declined, I don't know, maybe 15% thus far, you're seeing a 31% outperformance. And that's why retail investors tend to do better, because we don't have that itchy trigger finger. We can wait for these exceptional opportunities to come to us. And if they don't come, no problem, because there's nobody breathing down our necks to deploy this capital. It's all on us. Another fund manager said that I think you've already seen the bottom in the stock, and 12 months from now, I think you have a better chance of it being up 20% than down another 20%. And I agree with this sentiment here. Target is a strong retailer in this environment, and they're probably going to get ahead on the inventory issue because they were the first ones to really call it out and try to get ahead of it. So I agree with this sentiment, but what exactly does the valuation look like from my perspective? And I'm going to let you guys know in this video. But first, let's start with what Target has said. So they did say that in June, they announced that they're going to be right-sizing their inventory. And specifically, they're saying that while these inventory actions have put significant pressure on their profitability in the near term, they are confident that this is the right long-term strategy in support of their goals. And they've provided fiscal year 2022 guidance for the back half of this year. And they're saying that the current trends support low to mid-single digit revenue growth and an operating margin in the range of around 6% in the back half of the year. But what exactly does that look like when it's modeled out? Well, you don't have to do the modeling because I've done it for you. So you can see here that in fiscal year 2023, that's their end of 2022, I would say, their operating profit margin has been increased to around 5%, to be in line with company's guidance. Now they are guiding to 6%, but remember that the first half was lower than 6%, so it'll average to around 5%. I'm forecasting revenue to grow in the midpoint of that low to mid single digit range, so around 2.5%. And then thereafter, I'm only expecting revenue to grow at approximately 3.5%. So there is some upside on the revenue side. Also, notice that my gross profit margins are low in fiscal year 2023 and 2024. And I only bring it up to 29.5% thereafter. I think that's reasonable. However, you could see some upside there, but notice their operating profit margins going back to 2016. There are very few years which are running over 7%. So my forecast might actually be high, but the reason why I'm going to show you a higher forecast is because I want to show you that this company is not undervalued. But before I get into the valuation, I just want to remind you guys that approximately 80% of the watch time on this channel is from people who are not subscribed. So if you have an opportunity, please subscribe to the channel. Now here's my valuation of Target. So you can see that using a terminal multiple of 15 times earnings, which I think is reasonable for a company that's increasing revenues at approximately 3.5% a year, I'm valuing them at approximately $155 per share. That's taking into account the fact that they have debt on the balance sheet, which penalizes their valuation by approximately $29. So compare that to their current share price of $163 per share. You can see that they're on the fairly valued to slightly overvalued range. However, there are people that may want to use a higher terminal multiple just because it's a more powerful retailer overall. And so if I leave everything else the same and I just apply a 25 times earnings multiple, you can see how this company is valued at approximately $240 per share, which makes it significantly cheaper than what I'm valuing at. So it really just comes down to, where do you see revenue growth happening? Is it as low as what I'm predicting, or is it higher in subsequent years? And what sort of multiple do you want to apply to this? I'm not comfortable applying a multiple over 15 times earnings, but you might be. So something up to you. But I highly encourage you to take a look at that target model and see sort of in detail, line by line, how I'm valuing this opportunity out. Now, the question is, how do you get access to that model? Well, you can get access to that model and all the other models that the Patreons have access to at the lower tier of the Patreons. And if you want to join us for a live monthly call, you can join us at that upper tier. Now, I actually did a full video on that whole Target situation as it was developing. And so if you want to get a better understanding of what's been happening to Target this year, you can get access to that video right here.